and kind of keep things moving now. The next speaker that we have is Don Fishback. Don, I know you're here. I see you. I'm going to go ahead and turn on your audio, and hopefully we don't have any issues with it. I just want to make sure that it's working properly. So your microphone should be on. And why don't you say
hello?
Hello, there you are.
Hello. I'm assuming you can hear me well?
I can hear you. You sound like an angel.
That's because I am. At least I am this morning.
Let me tell you guys a little bit about Don. Don, while I'm doing this, I'm going to send the sharing over to you so you can start to get your screen ready. Don is somebody that I really like in terms of his ability and kind of the way he looks at markets are very, very unique. A lot of the stuff that he looks at, and the reason they're unique, is he's looking at a lot of non-directional base strategies. So yeah, a lot of times you're usually looking to go long or short on a stock, or you're looking to buy a put or a call. With Don, what he looks for is very much different, and one very, very unique to Don, and a non-directional strategy. But I don't want to kind of get too much in the woods and spoil it for you guys. So Don, how long have you been working with MetaStock? It's been a while now.
You know what? In fact, can you see my screen, Jeff?
I can see it. Do you want me to just let you go?
Yeah, because I'll just show you right there. Started using MetaStock in and that's an 8. That's 1988. So that was quite a long time ago.
Don, the floor is yours. Go.
Okay, folks. So I am Don Fishback, and I just have a quick, brief disclosure, and I'm not going to read it, unlike Jeff, who can recite stuff just. Jeff, how long does it take you did it take you to memorize that disclosure part?
I still mess up once in a while, but I've done it like probably 3,000 times now.
There you go. Well, so here's a full disclosure. You can read it at our website if you need to. And we're going to be using a lot of trademarks. And Jeff has been talking about my involvement with MetaStock. With MetaStock, you're going to see experts and explorations and things, and a probability cone, all based on odds. And so that's what we're known for, is odds. And I am the president and founder of Fischbach Management and Research, 33-year veteran of the financial business. Started using MetaStock in 1988, shortly after I got into the business. And I started my company over 24 years ago. And I've been called, it's funny because I've been called a lot of things. I've been called by many people the leading authority on helping people make options investing easier and more profitable and less risky. And that's one of the things what we're going to do. We're going to be talking about how to make some of this stuff easy and more profitable and less risky. Jeff has got a little moniker for me. He calls me the mad scientist. I am recognized as a expert in the field of probability and its application to options. Been quoted in all kinds of media outlets, including one that you might not expect, and that's the New England Journal of Medicine. Cited me as an expert on probability and its application to the financial markets in their back in a past issue. At any rate, I have been a part of MetaStock for a long time. I created something, created an indicator, and the folks at MetaStock added it to the program 20 years ago, back in 1996, I believe. It was either 96 or 97. So I've been a part of MetaStock for a long time. I'm a huge fan, not just because of the quality of the tool, but the quality of the people involved. I remember way back when it was a dial-up modem, and I was having a problem with a text string that the modem had to send. And the folks, the support people on MetaStock, were just such a huge help, and they would not get off the phone. until my problem was solved. And so that's the kind of thing that's important to me, is the kind of service that you get. And so I wanted to be involved with the company, and both companies have a like-minded vision in terms of servicing the customer, and it's been a happy marriage ever since. One of the things I want to bring up about this particular chart is really interesting. Is we discuss odds and probability, and that involves statistics. And these probability cones, you can draw them at a certain probability. These particular cones that you're looking at right here, the white cones, are they're set at one standard deviation, and that's important, because one standard deviation means that the interior area of one standard deviation is about 2/3. Outside one standard deviation is about 1/3. We've all heard, like, between plus and minus one standard deviation, about 2/3 lie between plus and minus one standard deviation. About 95% lies between plus and minus two standard deviations. Well, this is the one standard deviation move, and it's using the 1 year implied volatility, and it's projecting out 1 year. And so what you would expect is, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. There's 13 years. And so you would expect about between 4 and 5 times for the market to move outside that projected range. And you can see that it moved outside that projected range here in 2008. So this is going back to 2004, and it's going back to the inception of SPY. We're looking at the SPDR, S&P 500 SPDR, and we're going back to the inception of those options. So we're looking at implied volatility of 1 year options, and so we're projecting out 1 year, and we would expect it to be between inside this about 2/3 of the time, and outside 1/3 of the time, so about 4 or 5 times. It's only outside 3 times. And you can see here in 2008, it moved outside, and it's outside of that at the end of the year, and then inside. And then here in 2013, we had a big rally that took it outside the range, and then it's inside. And then 2017, it actually moved just slightly outside. So you would expect it to move outside, be outside that range 4 to 5 times. It's outside that range only 3 times. And that's going to be important when we talk about movement, because as Jeff said, we talk about the size of the move as opposed to the direction in this particular instance. So what we're going to do is this session is about profiting from compression. And we're going to look to spot high profit option trades on stocks that are flat for no fundamental reason. And it has some key advantages. One, it's based on proven research. So we're going to go into that a lot. We're going to go into a lot of that later today. It's repeatable. And that's one of the things, we're not going to look at a chart and say, well, nothing against technical analysis, but it's not my area of expertise. I want something that's just the results that I get should be the results that you get if you follow the same process. So I'm a big fan of technical analysis, but I really, even more so, I want it quantifiable. So our results can't deviate. The nice thing is it doesn't take a lot of time. The analysis is fast, and you don't need to follow the market during the day. It doesn't take a lot of money. Some trades cost as little as $70. I mean, we put a trade on just a few weeks ago that cost $120. So it's not expensive. It's suitable for most individuals. You don't need to be a pro to do it. And a key advantage is that by the end of the session, you're going to know why it works. Knowing why is the key, at least it is for me. is I can't do a black box where somebody just issues a signal. I need to know why it works so that I have the confidence to actually do it. So if you're like me, knowing why it works is important. And that's one of the things you're going to learn today. So the concept behind all this, it's based on the principle of finding a flat stock that has gotten too compressed. So once you find the flat stock, then you look for the appropriate option strategy. And once you find the right strategy, you make sure that the price is right. And if everything lines up, you implement the trade. So it's a very simple step-by-step process. You just have the 3 steps. You find the stock that's flat, find the right strategy, and then find the right price. And then if those line up, implement it. So it's a very simple step-by-step process. So the strategy, we need to talk about what kind of strategy. We're going to use what's called a straddle as our preferred strategy. So what is a straddle? A straddle is the simplest option strategy designed to profit from a big move up or down. So we're taking direction completely out of it. A straddle is a simultaneous purchase of a call and a put with the same strike price and the same options expiration date. So it's very simple. You just buy a call and a put at the same time, same strike, same expiration date. With the straddle, you need to do more than just choose to buy or sell. So like if you look at a stock, it's like a stock is at $30. You say, I want to buy the stock at 30. Well, there's more to it than that with the straddle. You need to choose the strike price. And so the strike price that we want is this, it's called at the money, and it's the strike price that's closest to the current stock price. So let's say the stock is at 30. You would buy the 30 call and the 30 put. If the stock was at 31 and they had a 31 strike, then you would buy the 31 call and the 31 put. If the strikes are only at 30 and 35, which is the way it is sometimes, then if the stock is at 31, you would buy the 30 call and the 30 put. So it's the one that's closest, the strike price that's closest to the current stock price. The expiration, you need to choose the one the one that you these things expire. It's not like a stock where you buy a stock and you can hold on to it, like Warren Buffett said, hold on to it for eternity. Options expire, and so you have to choose an expiration date. And as the technology has gotten better, the number of options expirations has gotten ridiculous in some instances, where you now have the regular monthlies, which is the third Friday of the month, but then you also have weeklies, which are every Friday for a few periods. They've also got Wednesday expiring options now. SPY options expire on Wednesday. They've also got Monday expiration options. So SPX, you can the S&P 500, the big contract, the index option, they have Monday, Wednesday, Friday expirations. So what I suggest is there's 2 things about this. We're going to talk a little bit about timing when we get into this a little bit further, but we suggest that if you're going to look at the strategy, we suggest that you do some testing on your own to see which one you find is best, but also make sure it suits your personality. And I'll give you an example. Let's say you have a system that you're using MetaStock for trying to pick out a system, and your system gives signals that tend to last 1 month. Well, one thing you don't want to do, if the signals tend to last a month, you don't want to buy a 1-week option, because the option is going to expire before the signal ends. But once you get beyond that, you know that you need at least a 1 month option. But do you go exactly 1 month, or do you go buy a 2-month option or a 3-month option? Because the way options work, there is a decay that speeds up as you get closer to expiration. There's a time decay. Some people might be willing to buy, the longer term you go, the more expensive the option tends to be. So some people might be willing to spend more so that they avoid that rapid decay at the end. Some people might say, you know what, I want to pay less and I'm willing to live with that rapid decay because I am ready to, I don't mind taking on that kind of risk. So you really need to, that's where some personality comes in. Personally, if I have a signal that lasts a month, I want an option that's like 6 weeks to 2 months in duration. So that's my personality. I want an extra 2 weeks to an extra month of time. So that's my personality. This is what a profit loss of a straddle looks like. And you can see on the x-axis, the x-axis is the stock price, and the y-axis is the profit and loss of the strategy. And you can see if the stock price goes down a little bit, then the strategy loses money. But if it goes down a lot, it makes money. Same thing, if the stock stands still, it loses money. If it goes up a little bit, it still loses money, just not as much. But if it goes up a lot, it makes money. So the maximum risk in a straddle, it's the amount that you pay to buy the options, to both options. The maximum profit is unlimited. The break-even price, that price where the profit loss crosses from, where the profit loss crosses from a loss to a profit, that break-even price, it has two break-evens, a lower and an upper. The lower break-even price is equal to the strike price minus the net debit of the call and put, and the upper break-even price is the strike price of the straddle plus the net debit of the call and the put. And the reason why we like straddles, like I said, they're pretty simple. You buy a call, you buy a put. The reason you do that is it's a pure volatility play. As this chart shows, you don't care about direction. You just care about magnitude over time. So straddles only depend on the size of the move over the certain period of time. Straddles, now there's some realities about straddles that everybody has to be aware of. Straddles are not a high probability trade. You tend to lose more often than you win, but that's all right if the size of the profits are sufficiently large, and we'll show you why we still do this even though you might lose more often than you win. Buying straddles, though, if you don't have a systematic method, straddle buying tends to be a money-losing tactic. Buying straddles on stock indexes is particularly bad. So I don't want anybody to think, well, I'll just go out and buy straddles and I'm just going to, it's going to be printing money because Don said you can make money with straddles. That's not true. In fact, one of the things, I read a lot of research. I read a massive amount of research. And these are some summaries from various research papers. The first three were looking from buying straddles from 1990 to 1995. If you were I do need to make a correction there. It says weekly average. I converted, the paper gave the weekly average, but I converted it to the monthly average. The monthly average of buying straddles on the S&P 500 from 1990 to 1995 is losing 12% a month. And from looking at a different time period, the second research paper, they analyzed it from 1985 to 2001, and it's minus 14% a month. And then from 1987 to 2005, minus 15.7% a month. But then I have the data going back to 1998, we have one of the biggest options databases on the planet, and one of the most advanced options databases on the planet as well. And if you looked at buying straddles, if you just bought S&P 500 straddles, so like let's say it's January options expiration, and you buy the at the money straddle on the third Friday of the month, and then you hold it to the third Friday of February, and then February you sold the option that was in the money, and then you did on February you bought the at the money straddle for February for the March expiration, and you held that until March, and so on and so forth, and you just did that. What would your return be? You would be losing 10.5% per month from 1998 to 2017. And so this gives you an idea of just pure straddle buying, just so a non-systematic method. You're not using any timing, and you're buying straddles on a broad-based index as opposed to an individual equity. This is what you end up with, and you can see you're just getting it's not good. You see it got a little blip up here in 2017 because the calls made so much money, but generally speaking, buying straddles has been a bad thing. So if the performance is so poor for straddles, then why would we even bother wanting to implement them? And this is one of the reasons why, this is one of the reasons why options have a bad reputation, because it looks terrible. So why would we implement them? Well, as the statistics imply, traders tend to overestimate volatility. That is movement over time. Traders tend to overestimate volatility most of the time. But in certain key situations, the opposite occurs. Traders tend to underestimate volatility, and that's when we have an opportunity. So the question is, when do traders underestimate volatility? And the answer is when stocks go flat for no fundamental reason. That's the key, when stocks go flat for no fundamental reason. And here's an example. This is a recent example. This is from back in just last month, back in December. There's FCX. It's Freeport McMoran, and you can see the stock has gone flat. And Jeff had been talking about earlier, he had been talking about our add-in. Well, this is an example right from the add-in. And the add-in shows if you look here, we've got a variety of moving averages, and we have this expert signal right there, that OVC, that's for the odds volatility compression. And you can see we have a bunch of white bars, but we've got this bar right there is colored a little bit differently. And then we have an indicator down here, and it's the odds volatility compression ratio, which is a indicator that I created and is part of the add-in. And then right here, this little dots right down here at the bottom, there's a little blip up right there. That's the odds volatility compression signal. So there's the signal that triggers with this expert. And so we get this right there. So basically, when the compression ratio and the signal both match up, you get this little vertical bar, and you get this right here. And so that's telling us quantitatively. I can look at the chart and see that it's compressed. I mean, you can see that it's getting narrower and narrower. But there's no room for interpretation there, folks. That's just a flat out. There's a signal right there that shows up. So it's really that's the kind of stuff that I really like. Well, once you get that signal, we said you look for the flat stock, then you look for the right strategy, and then you price it, and then you implement it. Well, what happened after that? And this is what happened after that. And remember, we're looking for a big move. Well, you can see this stock, it went from 14 up to 20. That in percentage terms, that is an absolutely massive, that's a massive move. So that's what we're looking for. We're looking for the flat stocks, and once we get that compression, then we have an expectation that within a certain period of time, the stock is going to make a big move. So how do you, that flatness, this signal right there, that signal, how do you measure that? Well, I got the idea actually. It's interesting. As Jeff said, I've been a long time user of MetaStock, and when you buy MetaStock, they have all kinds of templates and charts and layouts and things that are just part of MetaStock. And so I was just looking at some charts and playing around with some of the templates, and up pops the Daryl Guppy MMA template. And I thought, well, that's really interesting. And here it is. This is that Freeport McMoran with the Daryl Guppy MMA. And what all of you can see is that it's multiple moving averages. I guess that's what MMA stands for. It's multiple moving averages. And you can see when all those moving averages converge to a single point, to a very, very narrow point, you've got that compression. And it's like a coiled spring that has just been compressed too tightly, and then it finally just rips loose. And that's what we expect, and that's exactly what happened with FCX. So this is that same chart. It's this chart instead of the odds compression add-in right there. This is the Daryl Guppy MMA. So that's pretty interesting, I think. So again, we created an indicator that measures that convergence, and we've included in our Metastock add-in, and the indicator is called the odds compression ratio, and it includes an expert that provides the signals. It also provides the exploration capabilities, and it also provides expert commentary. Like, once you get the signal, then what should you do with it? Well, the expert provides those kinds of instructions. So that's what it looks like. And the signal is just getting back to this chart here. If you look in the lower chart, you've got that compression ratio that's going up and down, and then the little bars, the little dots down at the bottom is the signal. What prompts that signal? Well, what we've found is that when the odds volatility compression ratio hits an extreme low, the moving averages have converged to the point that the asset is extremely compressed. And at that point, the stock is more likely than not to break out of that odds probability cone. Because remember, when we looked at the odds probability cone for the S&P, the S&P spiders, we found that the asset actually tended to stay inside the probability cone more frequently. We expect it to stay in there about 2/3 of the time. It actually stays in there about more than 75% of the time, about 77% of the time. So when you get that compressed situation, though, it becomes more likely than not. So it becomes more likely, more than a 50-50 chance that it's going to break out of the probability cone. So it completely changes the odds when you get one of those signals. And here's another example. This is the Old Dominion, and we got a signal back in May of last year. And there's the probability cone, the red probability cone. And so you can see when the stock gets compressed, when those moving averages converge, the stock is likely to make a big move outside of that probability cone. So that's the key thing that we're looking for, because the options, if it moves outside that probability cone, in this particular case, the call is going to make money, the put's going to lose money, but the call is going to make so much money that it offsets any losses that the put suffers, and then an additional profit on top of that. For instance, that the FCX trade, put it on for about $148, and the thing went all the way up to 20, and it was a 14 strike option. So that's, the call was worth 6, which is $600. So the straddle for $148 and sold the call for $600. Well, we quadrupled our money. We quadrupled our money on where one of the options lost all of it. So that's how this works, is that one option makes so much money that it offsets the loss of the other one. And that's what happened in this ODFL. If it breaks out of that trading range that is bound by the probability cone, you're likely to make a big profit, which is what happened right here in ODFL. And anyway, so you get that compression. It's likely to break out of that range. So the thing you do is you buy a straddle. But the question is, at what price? Well, we use a proprietary option value, but I'll talk about that in a minute. But first, I want to discuss probability, because after all, it is odds, right? So this is the Black-Scholes model. I'm sure a lot of you have heard about Black-Scholes. The option, they used to have, I don't know if they still have it in Metastock, but there was an option thing in Metastock. You definitely have it in the Icon, the Metastock Zenith, which I'm a huge, Jeff knows this very well. I'm a huge fan of Zenith. I depend on it every day. And they use Black-Scholes in the Zenith product. Well, this is the partial differential equation part of the Black-Scholes model, which won the Nobel Prize in Economics back in 1997. If you solve that PDE, this is what it looks like. And there's different versions of it. This is the one right out of the paper by Black and Scholes. This is what it looks like if you were to get the paper and look at it. This is it. I've got two arrows pointing at that end. And the reason I got it pointing at that end is because it has to do with this right here. Well, folks, hopefully all of you are familiar with the bell curve. It's pretty interesting that we're including that, and the reason is that n of x. So in this particular thing, they're using n of d1 and n of d2, and there's some equations for d1 and d2. I didn't want to bother overloading you with too many formulas, but that n has to do with the area under the bell curve to the left of x. So n of 1 would be the area under the bell curve to the left of 1 standard deviation, and n of 1 is about 84%. So the area to the right of 1 would be about 16%. And by the way, that x-axis is in standard deviations. So the area to the right is about 16%. So based on symmetry, the area to the left of -1 would be about 16%. So that's between plus and -1 is about 68%, and outside of plus and minus 1 standard deviation is 32%, or about 2/3. So that's where you get this 1 standard deviation is about 2/3 of the outcomes lie between plus and minus 1 standard deviation. Well, that contains, unfortunately, that's the N right there is part of the option pricing model right there. So the option pricing model assumes this, which is fine, but most of the time, but it contains a flaw. And this is an example from a spreadsheet that I created back in 1996. If you actually count the number of times that the stock moves plus or minus 1 standard deviation, or 2 standard deviations, or 0.1 standard deviations, you find that the stock actually, it doesn't really follow the bell curve. So if you're using an option model, a Black-Scholes option pricing model, to price an option, and you're not aware of the stock may not move like the bell curve. I mean, it just may not. So your option prices may not be realistic compared to what the stock actually does. So again, this is something I created back in 1996. It's part of Bloomberg. They use this method. Icon has an interesting version, or Zenith has an interesting version. It's not quite as sophisticated as a Bloomberg terminal or this, but they're making some rapid improvements to it. But even this contains a flaw, and the flaw is, for those of you who are familiar with this stuff, it's autocorrelation or serial correlation. So there's a way to perfect that, and that's something that we've done here. And it's a new way to value options. And so this is a more realistic, this is a true, more realistic comparison between Freeport, McMoran, and the assumed distribution in the option pricing model. And what you can see here, folks, this is interesting, because what this basically shows is it shows the assumed distribution, that's the bell curve, versus the actual movement in the stock. And you can see that FCX tends to make much larger moves than are anticipated by the option pricing model. So the thing makes bigger moves than the options are expecting. So that's the key. That is the key. Does the stock, we talked about how with straddle, sometimes you don't actually get the movement that's expected, and we showed that with the S&P 500 spiders, that it stayed within those probability cones more frequently than expected. Well, this one moves outside more frequently than expected. That's what this illustrates right here, and that's a big plus. If you're buying, if you want big moves, this is a big plus. So large moves occur more frequently than the theoretical models expect, and that's very good for long straddle. If you're buying straddles, long straddles. So how good? Well, the Fischbach option value solves that problem. And this is our software. This is an image from our software. And this is taken from a little over a month ago. This is that FCX position when the stock was at $14.35. And here we're zooming in on the option chain, and we're looking at the 14 strike, and we've got the bid, the implied volatility of the bid, the ask, implied volatility of the ask, and then we've got the value, that 1.36. And you can look, a couple of things I want you to look at. Look, the bid is 0.92 and the ask is 0.93. So the bid ask spread is only a penny, and The ask is significantly below the value, and then the volume over here is 761. So this is the calls right here. And so you've got plenty of volume. You've got a narrow bid-ask spread. You've got the ask is well below the value. So that's good on the call side. And then we look on the puts, and you can see we've got 53 versus 54. Again, a very narrow bid-ask spread. The 54 is well below the value of 96.31. And also you got lots of volume here at 413. So this thing's got liquidity, and it's got plenty of liquidity, and you've got the value, the price is way below the value. In fact, if we're going to buy the call and the put, the price is 1.37. The value is 2.33. So the price is much less. In fact, it's 37% less than the value. So that's the kind of thing that we're looking for. Basically, the stock has gone flat for no fundamental reason, and options traders do not expect this thing's never going to move again. Well, that's exactly what we want. That's exactly what we're looking for. So we can, just to give you an idea, it's like how important is the value? Well, we looked at a 12-year period. We have this stuff going back to 1998. We did a 12-year test. We were equity options only and no index or ETFs. So we didn't look at indexes at all. And one of the reasons we didn't look at indexes has to do with what I was talking about previously. Indexes, they're broad-based. There's diversification. They tend to stay flatter. I don't want to get into it too deeply, but they tend to stay flatter, have lower volatility than the individual equities. So we just looked at the equity options. We created a straddle for so we look at all these signals that the Metastock expert can create. We created straddles for every one of the signals. We took trade duration of 21 to 49 days till expiration. And so that's 5,400 straddles trades that we looked at. And then the exit was we were going to just hold till expiration. Then we calculated the return for each and every one of those 5,400 straddles. And then we calculated the average return of all trades. And what we found is that the average profit of all straddles after a compression signal was 2.3% per month, which is 31% a year. Now, I want you to go back to that other thing that I showed where, let's go back to this table right here. This is the performance of straddles if you don't use any timing system, right? Minus 12% a month, minus 14% a month, minus 16% a month, and minus 10.5% per month. So the straddles look terrible if you just blindly buy them 1 month, then the next month, then the next month, then the next month. But if you start timing them and say, you know what, I'm only going to do this selectively. If I'm going to do this selectively, that boosts the profit to 2.3% per month. So doing nothing but looking at, not doing it on indexes, but doing it on equities, and only after a signal, you really substantially boost the profit per month, just tremendously. But that's before the value. We haven't considered the value yet. So if we calculate the value, we're going to calculate the price. We're going to take the price divided by the value for each one of those 5,400 straddles. And then we're going to sort based on that ratio, and we're going to divide it into deciles. And so we're going to calculate the average performance of each one of the deciles. And that's what we get here. And now you're really talking about something, because when you look at the straddles that are cheap, like that FCX straddle we're looking at, which was in decile 1, now we're looking at positive 23% per month. So we've gone from minus 10.5% per month up to 2.3% per month, up to 22.9% per month. So we went from negative to positive to extremely positive just by refining the timing system and then throwing in the value. And even the decile 2 is really good at plus 12% a month, because what is that? That's about 144% annualized per year. I mean, you know, it's about, I'm just doing simple, not doing geometric stuff, just doing arithmetic averaging, annualization. At any rate, cheap is good. Cheap is good. And so there's the rules. We're going to search for compressed stocks. We're going to use the MetaStock add-on to search for compressed stocks. We're going to analyze straddles on compressed stocks. We're going to implement straddles on those compressed stocks when the price is significantly below the value. And then we're going to hold till expiration. It's really simple. Be sure to exit. The one thing is, be sure to exit the in-the-money option before the market closes on expiration day. In this thing, you gotta get out, because if you don't, you might get assigned a position in the stock. So that's the only thing. You've got to get out of the options before they expire. So I thought I'd see what's going on today. So you can see this is as of last night's close right there. So the first step is to run through the compression, the exploration, and I did it earlier this morning because I didn't want to take it takes about 6 minutes to run it, and I didn't want to waste any time. So you got the compression, you run that, and this is the report you get. You got Charles River Labs, double line income, and gaming and leisure properties right there. And Charles River Labs, this is the chart, to get the value of, so again, we get the compressed stocks, and now we're going to analyze the straddle on the compressed stocks. And there's Charles River Labs. And I want to zoom in there, and this is an issue. There was no volume, absolutely no volume. The open interest, there's only 2 contracts of open interest. And look at the bid-ask spread, $3.60 by 440. That's massive. What is that? 80 cents? 80 cents? That's a gigantic number. And then you look at on the put side, it's no volume, no open interest. The bid ask is 510 by 640. That's $1.30. That's just it's crazy. And not only that, look at the ask price compared to the value. The value is 2.9787 on the calls. The ask is 440. So the price is way above the option value. Same thing for the puts. So this is not a good situation. We would definitely take a pass. Gaming and leisure properties, you can see the option chain down there. There's at least some open interest in the options. But if we get down and we look at it, the bid ask it's narrower, it's better, but again, low volume, extremely low open interest. The bid ask spread is better, but it's not great. The call ask is actually right around the option value, so we really don't have an edge there. The edge, we want to buy it cheap, not for the value. We want to buy it under the value. And then if you look at the call, the put ask compared to the value, the put is quite a bit overpriced at $1.15. So again, this one is not anything. And then the double line does not have options traded on it. So there's really nothing to do for Monday. I was hoping we'd have a trade and get you all excited for something to do, but there's nothing to do for Monday. So anyway, that's it. I am done, and I appreciate the time to explain this to you. If you want to get in touch with us, you can email us support@donfishback.com, or you can give a call. It's like hitting the jackpot, 855-777-ODDS. So I want to thank you all for watching. And with that, Jeff, if we got time for a couple of questions, I'd be glad to take some questions.
Hey, Don, great job. Pauline says, my understanding of straddles is a lot better. Thank you.
Well, good. Thank you, Pauline.
We had a question and we don't have a lot of time, but there was a question that I thought would be interesting to ask you a little bit earlier. And I'm just trying to locate it right here. It had to do with what expirations you like to pick with this strategy. Do you think you can answer that in a minute or less?
Yeah, absolutely. We're looking for, again, the signals tend to last about a month, so, or about two to 3 weeks. So we're looking anywhere right here. If you look, we're looking at trade duration of 21 to 49 days.
Okay, awesome. So, yeah, I know there's a lot of people here, hundreds. So if we didn't answer your question, Don does want to hear from you, and reach out to him at support@donfishback.com. He and his staff are so good at kind of getting those questions answered and that kind of stuff. So with that being said, Don, do you have any final thoughts?
No, I just, other than I gave a plug for Zenith, and when you were talking about Metastock earlier, and is that offer? What is the 3-month offer?
So that's a good question. I'm actually going to cover that real quick. I want to basically our 3-month offer. If you want to try Metastock out, we have 2 options. Our DC version starts at like $59 per month, and our real time starts at about $250 per month. What we're doing is we're actually offering that as a buy one get 2 free. So like if you start it today, you'll start in like it's January 27th according to my calendar. You'll literally be running it into April, and for as low as like $20 a month. I'll tell you a little bit about that as well. I do want to talk a little bit about the add-on for.
Can I just?
Yeah, go ahead,
folks. If for this kind of deal, if you don't take it, so for $250 they get 3 months of Zenith
and Metastock.
But I mean, you spend the $250 to get Zenith for 3 months just to try it out. You'll be shocked at how good that is. I depend on it every day. So it's not just Metastock. It's you get that beautiful quote platform for 3 months for $250. That's amazing. So okay, so I'll let you talk now, because I wanted to find out if they got Zenith too, because that's an amazing
Yeah.
deal. Okay.
I'll let you keep talking nice about Zenith if you want to. Just kidding.
Okay.
To give you an idea of what Zenith is, because we do talk a lot about Metastock today, but he's right. Metastock Zenith is a product that Thomson Reuters put together. They spent over $1 billion on it, and they market it as a competitor to Bloomberg to institutions. It's supported by, like, you can get stocks and futures and Forex and just about anything you want in it. They brag that they have like 92% of the entire global market cap, which means if you're in London, you can get London information. If you're here in the US, you can get US information. They have something like 20,000 reporters that are actually in 200 different bureaus that actually report real-time information on the markets. Everything is organized. You have so much information that's available in there. And the price that we charge for Zenith is like a fraction of what you would pay as an institutional trader, and it's access to the same data. So it is an incredibly valuable product. And Don, I really appreciate that. Since we're talking about really good products, I just wanted to kind of give you an idea of how this Don Fishback's add-on works inside of Metastock. And we don't have a lot of time. I'm going to do this in like a minute, but we can certainly show you a little bit more later on. I have a full hour that could kind of come in and talk about this. But if this is the Metastock platform, I did run a scan against the optionables today. There was a little bit of a hit on about 4 different stocks. So if I come into I'll just kind of give you an idea of how this works. Here's the exploration dialog box. What I've got selected is the ODDS scan. So right here, odds, volatility compression. I scanned it, and just to kind of give you an idea of that market coverage I was talking about a second ago, you can scan it against anything you want, whether you're like in Asia or Europe, or maybe you're interested in Forex or whatever you want. 92% of the global market cap, 381,847 listed instruments in this list. But what I did is I ran this scan against the optionable stocks, and it just comes up with a little bit of a report. That report did me a favor and opened on a different screen. Let's bring it over here. And out of those 4,800 stocks, there's about 3 that kind of came up on that list. Okay. When I go in here and apply the template to Metastock, and I just opened up one of them, you'll see that it has an OVC thing. Okay. And basically that means that there's basically a compression signal. It's like a coiled spring, if you would. Okay. So instead of looking at 4,800 stocks, you can look at this one. This is what we're looking at in terms of the compression ratio down here. When it's the lowest value, I think in 2 or 3 or maybe 4 years, you get a little bit of an up. 4 years. Yes. And it gives you a little bit of a buy signal here. And it tells you exactly what it's looking for. The stock's price and its short and long-term moving averages converged into a narrow range. This means option strategies designed to make money out of stock breakouts are appropriate, and it kind of gives you some advice for what you should do with the straddle and that kind of stuff. Don has developed a very, very intensive, and he showed you it, options app that you can kind of log into and kind of take a closer look at. But this is kind of how it kind of folds into Metastock. Basically gives you the exploration, allows you to look at all of the indicators, and gives you some really good advice here on the side. And for this, and for all of this work, basically, it's only like $399. Now, that's a one-time cost. It does push itself into Metastock. If you buy it at the summit price and that's all you're interested in today, you'll pay $299 for it, okay? And to order that, what you can do is you can call 800-882-3040, okay? We do have reps that are here. I understand the phone lines were a little bit busier earlier. They are available to take your calls. Metastock.com/saleschat. You can also chat with them online if you're international, okay? But I'd recommend that you get the special offer. So for $399 basically, or for the end of day, or $590 for the real time, you can get Don Fishback's option compression. You can get Bollinger Band Toolkit. You'll get 3 months access to, you'll get lifetime access to Don Fishback, 3 months access to Bollinger's Toolkit, 3 months of Metastock, Unleash the Power of Metastock, a course that shows you how to do everything, and a special boot camp that I'll be running personally on February 15th at 6 p.m. Eastern. So again, it's just $400, $399. If you added all of that up, and my math is correct last night when I was putting together the slides, normally all of that would cost you $921, okay? You can also do the real time that includes Zenith with it, and that would cost you $590. So to order that, give us a call at 800-586-8016, or visit us online. Again, the chat information is metastock.com/saleschat. Okay? All right, very cool. Shifting gears a minute, I do want to kind of talk a little bit about our sponsor today, Modern Trader Magazine. It's a great publication. I really like their covers. Right here, one of the things I've noticed is you get a little bit of a different notice here, and sometimes they're very unique and clever. But what they're going to do, they want you to go ahead and take a look at the magazine. I think you'll like it. It's very, very nice. They're going to actually allow you to get a 4-month trial without a credit card for their digital edition. Okay, and so to do that, I'll just paste the link up into chat right here. Hopefully it's still on my clipboard. Okay, go ahead and click on that link. It's going to ask you for a promo. You don't have to fill that in. As long as you don't type over it, it'll automatically be populated. But a lot of people have been asking, well, what's the promo code? Well, if you want to type in the promo code, it's all lowercase promo. I've tested it. It works. It'll get you signed up. It's free. And there's no ongoing commitments. They're not going to ding your credit card in 4 months. It just allows you to try it out totally free of charge. Okay. So there we go.